A woman I'll call Denise rang me 2 years after her father died. Probate had been granted. The solicitor had told the family the estate was settled. She'd already used some of her share to help her daughter with a deposit. Then a letter arrived from HMRC querying the value declared for her father's house and asking where 3 separate withdrawals from his account 18 months before he died had gone. Denise's first question to me was the same one I hear from almost everyone in this position. She thought a grant of probate meant HMRC had finished looking. It doesn't. It never did. That gap between what a grant of probate actually confirms and what people assume it confirms is where a lot of unnecessary distress in this process comes from. So today I want to walk through what HMRC genuinely checks before an estate is released, what triggers a closer look, and what stays open long after everyone thinks the matter is closed. This affects more families than it used to. Property values have climbed for years, while the main inheritance tax threshold has sat exactly where it was in 2009. That means estates that would once have passed through without a second glance now sit close to or over the line where HMRC pays proper attention. If you're an executor or you're expecting to inherit and you're the one who'll end up fielding the questions, this is worth 20 minutes of your time. Being an executor is an unpaid job most people take on once, usually while grieving, with no training and a genuine legal duty attached to getting it right. The law makes personal representatives responsible for the accuracy of what's declared to HMRC, and that responsibility doesn't come with a manual. Nobody hands you a checklist at the funeral. You find out what mattered, usually, at the exact moment it becomes a problem, which is precisely why I want to lay it out now, before that moment arrives for you. The stakes are ordinary, practical ones. Money that a family is waiting on, sometimes to cover care costs for a surviving parent, sometimes simply to move on with a difficult year, sits frozen until the paperwork clears. Get a valuation wrong or miss a gift that should have been declared, and the delay isn't measured in days. It's measured in months, sometimes longer, and it lands on people who are already dealing with enough. If this is useful so far, a like really helps the channel reach more people who need it. And let me know in the comments where you're watching from. I read them all. Here's the part almost nobody explains clearly before someone becomes an executor. A grant of probate is a legal document. It confirms who has the authority to deal with the deceased's assets, sell the house, close the bank accounts, distribute the money. It is not HMRC's sign-off on the tax position. Those are 2 separate processes running alongside each other, and conflating them is the single most common source of confusion I've come across. For most estates, the tax side is straightforward. Since January 2022, the majority of estates qualify as what's called an accepted estate, and for those, there's no separate long tax form at all. The executor enters the gross and net value of the estate directly into the probate application itself. No IHT 400, no schedules, nothing sent separately to HMRC. If the estate is below the available nil rate band or passes entirely to a spouse or a charity, this is usually the route, and it's genuinely simple. Where it stops being simple is where an estate doesn't meet those conditions. And this is worth being precise about, because I see people get it wrong in both directions. A full IHT 400 account is required where there's actual tax to pay, where the estate is worth more than £3 million gross, regardless of tax due, where the person who died gave away more than £250,000 in the 7 years before death, or where they held more than £100,000 in assets abroad, or more than £250,000 in trust. Any one of those conditions pulls the whole estate into the full account, even if the headline value looks modest. The house is where HMRC looks hardest, and it's worth understanding why. Property is usually the largest single asset in an estate. It's the easiest one to get wrong, and it's the easiest one for HMRC to check independently. The land registry records every sale, and that data feeds directly into HMRC's own systems. If a house is declared for probate at £340,000 and sold 8 months later for £410,000, that gap doesn't disappear quietly. HMRC can and does open a query, because the difference between the probate value and the eventual sale price is treated as evidence the original figure was too low, and the tax bill is recalculated on the higher figure. A genuine, professional, date-of-death valuation from an RICS surveyor is worth the fee. An estate agent's friendly estimate, done as a favour, is not the same thing, and it's the first thing HMRC's own manuals tell their staff to be skeptical of. The honest catch here is that a rising property market between death and sale doesn't automatically mean the original valuation was wrong. Values do move, but executors who declare a low figure because it reduces the immediate tax bill and then sell for considerably more soon after are the pattern HMRC's checks are specifically designed to catch, and the difference gets taxed either way. Once a full IHT 400 is needed, the account itself sits at the center of the process. It's submitted along with a supplementary form for each type of asset that applies: property, shares, gifts, trusts, and HMRC's stated target is to review it within around 12 weeks. Only once they're satisfied do they issue a form called the IHT 421, sent directly to the probate registry, and it's that form the court is waiting for. No IHT 421, no grant of probate, if tax is owed. This is the reason some estates with genuine, complicated assets take the better part of a year to reach the point where money can actually be distributed, and it's rarely the family dragging its feet. It's the queue. Gifts made in the 7 years before death are the second area that catches people out, and this one is less about dishonesty than about simply not knowing the rule exists. If someone gave their daughter £15,000 toward a car 4 years before they died, that gift has to be disclosed on the gift schedule of the IHT 400, even though it felt, at the time, like an entirely private family matter with nothing to do with tax. Gifts within 7 years of death can still be brought back into the estate for inheritance tax purposes with a reducing rate of tax known as taper relief, applying to gifts made between 3 and 7 years before death. Executors who genuinely don't know the full gift history because the parent never mentioned it are in a difficult spot, which is exactly why HMRC's own guidance tells executors to check bank statements going back that far as a matter of course, not as an afterthought. Take a realistic example. A father gives each of his 2 children £20,000, 5 years before he dies, and then leaves an estate worth £400,000. Added together, those gifts and the estate come to £440,000. Once the nil rate band of £325,000 is applied, £75,000 is potentially taxable at the outset, and because the gifts were made between 3 and 7 years before death, taper relief reduces the rate of tax charged on them, though not the size of the gift itself. This is the detail people find genuinely counterintuitive. Taper relief softens the tax rate on the gift as time passes. It never removes the gift from the calculation entirely until the full 7 years have passed. A gift made 6 years and 11 months before death is still inside the window, in exactly the same way a gift made 6 weeks before death is. Small, regular gifts have their own separate rules worth knowing, because not everything given away in those 7 years is automatically caught. Gifts of up to £3,000 a year fall under the annual exemption and don't need to be tracked in the same way, and regular gifts made out of surplus income, rather than out of capital, can also be exempt, provided they were genuinely habitual and didn't reduce the giver's standard of living. The distinction between a gift from income and a gift from savings is one HMRC does look at closely where larger sums are involved, and it's exactly the kind of detail worth raising with an accountant rather than guessing at. If you're finding this helpful, subscribe and turn on the bell so you don't miss the next one. I cover this stuff in plain English so you don't have to wade through 40 pages of gov.uk yourself. Assets held abroad or in trust deserve their own mention because they're the quiet trigger that pulls a perfectly ordinary-looking estate into the full account without anyone expecting it. £100,000 sitting in a holiday apartment in Portugal, or £250,000 settled into a trust decades ago and half forgotten, is enough on its own to require the complete IHT 400, even where the rest of the estate is straightforward and no tax is ultimately due. I've seen families genuinely surprised by this, because the instinct is to think about tax owed rather than about which conditions trigger which form. The two questions are related, but they're not the same question. Farming families and small business owners have a change to be aware of from April 2026 that alters a relief many had built their entire retirement planning around. Agricultural property relief and business property relief used to offer up to 100% relief on qualifying assets, effectively removing them from the inheritance tax calculation altogether. From April 2026, that full rate of relief applies only to the first £1 million of combined agricultural and business property. Above that threshold, the relief rate drops to 50%, which in practice means an effective inheritance tax rate of 20% on the value above the cap. If your family has planned around the assumption that the farm or the business passes entirely free of tax, that assumption needs revisiting with a professional who works in this area specifically, because the numbers involved are usually too large to guess at. There's a further layer that surprises even careful executors, and it's separate from inheritance tax altogether. Once someone dies, their estate becomes its own taxable entity for the period between death and the final distribution, known as the administration period. If the estate's investments or savings generate interest, dividends, or rental income while probate is being sorted out, that income is potentially subject to income tax in its own right, and it's the executor's job to account for it, not simply to fold it into the final distribution and hope nobody asks. Banks and investment platforms report interest paid automatically in the same way they do for living account holders, and that data reaches HMRC regardless of whether the account holder is still alive. An estate that takes a year to administer, holding a modest amount in a savings account throughout, can easily generate enough interest to need reporting, and it's a step that's simple to overlook precisely because it happens quietly, in the background, while everyone's attention is on the house and the will. Jointly owned assets are another area worth flagging, because the ownership isn't always as simple as it looks on paper. A house or a bank account held in joint names doesn't automatically pass outside the estate just because a second name is on the deed or the statement. HMRC draws a distinction between assets held as joint tenants, which usually do pass directly to the survivor, and assets held as tenants in common, where the deceased's specific share still forms part of the estate and still needs to be valued and declared. This comes up often with elderly parents who added a child's name to a bank account years ago simply for convenience, to help with day-to-day banking, without any intention of gifting half the balance away. HMRC doesn't take the account title at face value in situations like that. What matters is where the money actually came from and how it was genuinely intended to be used, which is precisely the kind of question that turns a seemingly simple joint account into something requiring proper explanation on the gifts or jointly owned assets schedule. Executors who assume a joint name automatically settles the matter are often the ones who end up fielding a query about it later, simply because nobody thought to look past the label on the account itself. Payment is the part that catches families off guard, even when the valuation and the gifts are entirely straightforward, because inheritance tax generally has to be paid before probate is granted, not after, and the money to pay it is often locked inside the very accounts probate is needed to unlock. This is what the direct payment scheme exists to solve. It allows the deceased's own bank or building society to pay HMRC directly from their account, using the specific IHT reference number obtained before the IHT 400 is submitted, without needing to wait for the grant. Tax is due by the end of the 6th month after death, and interest accrues automatically from that date if it isn't paid, regardless of how far probate itself has progressed. Understanding this one point in advance avoids a genuinely stressful few weeks where a family feels trapped between money they can see and can't yet touch. Here's what actually changes on the day probate is granted, and what doesn't. It confirms who's legally allowed to act. It does not confirm HMRC has finished. Even where an estate goes through the simplified accepted estate route with no IHT 400 at all, HMRC retains the right to open an inquiry into that estate's tax position for up to 35 months from when it was reported. Full formal clearance, using a form called the IHT 30, can take a further 6 to 12 months to obtain after probate itself, and most executors only bother applying for it just before the final distribution, precisely because it's the document that gives everyone comfort the file is genuinely closed. Distributing an estate's final assets before that clearance arrives isn't illegal. It simply means the executor is personally carrying the risk if HMRC comes back with a query later, which is exactly the position Denise found herself in. None of this should put anyone off acting as an executor, and none of it means HMRC is looking to catch people out. What it does mean is that the two places worth genuine care are the property valuation, which should come from a qualified surveyor rather than an estimate, and the 7-year gift history, which should be checked against bank statements rather than memory. If the estate is large enough, or complicated enough, to need the full IHT 400, build the 12-week HMRC review into your expectations from the start, and use the direct payment scheme if the tax bill needs settling before the grant arrives. If there's any doubt at all about foreign assets, trusts, or a farm or business that might sit above the new relief threshold, that's the moment for a conversation with a solicitor or accountant who deals with estates specifically, rather than working through the forms alone. In practical terms, that means a handful of concrete steps rather than a vague sense of caution. Get the property valued professionally and keep the paperwork, not just a verbal figure from an estate agent. Go through at least 7 years of bank statements specifically looking for gifts, not just obvious ones, before the IHT 400 or the probate application is submitted. Apply for the IHT reference number early if any tax looks likely to be due, since the direct payment scheme can't be used without it. Keep every valuation, every statement, and every calculation on file long after probate is granted, because the point of holding on to them isn't today's application, it's the letter that might arrive in year 2 or year 3 asking how a figure was reached. And if the estate touches a farm, a business, a trust, or assets held outside the UK, treat that as the signal to bring in a professional early rather than midway through, since those are exactly the areas where the rules shifted most recently. So, to bring it together, a grant of probate tells the world who's in charge of an estate. It doesn't tell HMRC the job is done, and it doesn't mean the file is closed, sometimes for years afterward. The house valuation and the gift history are where almost every genuine query starts, and both are entirely within an executor's control to get right from the outset. The forms, the thresholds, and the timelines all matter, but they're details sitting on top of that one central fact. Treat the paperwork with the same care you'd want someone to take with your own estate one day, and the process, while never quick, becomes considerably less likely to bring an unwelcome letter 2 years down the line. Quick note before you go. This is general information to help you understand how the process works, not personal financial, tax, or legal advice. Every estate is different, and for anything that affects a specific family's situation, the right next step is a conversation with a solicitor, a regulated accountant, or HMRC's own bereavement service, all of whom deal with exactly this every day. Thanks for watching to the end. If you found this helpful, share it with someone in the family who'd benefit. These rules matter most to the people who never hear about them until they're already dealing with a grant of probate and a stack of paperwork. And do check the official guidance at gov.uk before you act on anything specific to your own situation. See you in the next one.